The ticker on your screen is NVDA, and if you've been watching the charts, you know the narrative. The AI darling, the GPU king, the indispensable utility of the 21st century. But while the retail herd fixates on the latest headlines about price targets and buying the dip, they are missing the singular, brutal physics reality that actually dictates the company's valuation. We have hit the wall of memory bandwidth. The market is pricing NVIDIA as a software plus hardware play, but the structural bottleneck isn't just about chip speed, it's about the high bandwidth memory HBM supply chain. Every single Blackwell or Rubin class GPU you hear about is effectively starved of the memory it needs to operate at peak efficiency. This isn't a shortage like a limited run sneaker drop. This is a systemic manufacturing constraint where the wafer capacity for HBM is so heavily utilized by the current generation that NVIDIA is essentially paying a massive premium just to secure the physical space on the silicon floor. When you hear about demand exceeding supply, it isn't just that people want more chips, it's that the physical architecture of AI, with its voracious need for 192 gigabytes or 288 gigabytes of HBM, is pushing the limits of modern semiconductor fabrication. Institutional players understand this perfectly. They aren't trading the AI hype today, they're trading the HBM bottleneck. That brings us to the real-time drama currently playing out in the institutional corridors. We are approaching the August 26th earnings readout, and the sentiment is fascinatingly fractured. You see the macro jitters, rising long-term treasury yields, a softening consumer retail landscape, and a market that has become strangely jaded. Even after beat and raise quarters that would have sent this stock to the moon in 2023, the post-earnings reaction lately has been muted or even bearish. Why? Because the market has already priced in perfection. Institutional heavyweights are treating NVIDIA not as a growth stock, but as a defensive, high-beta utility. They accumulate shares during the volatility-induced pullbacks, knowing that the structural demand from hyperscalers, Google, Microsoft, Meta, Amazon, is non-discretionary. These cloud titans aren't experimenting with AI anymore. They are spending $200 billion annually to build out the backbone of the next industrial era. When the retail trader sees a 5% drop post-earnings and panics, the institutional desk is there to capture the liquidity. I have to ask you, in this environment of record-high bond yields and shifting macroeconomic winds, are you positioned for the long-term infrastructure play, or are you just trying to scalp the volatility around the next earnings report? To understand why this company has shifted from a consumer gaming house to the most consequential hardware architect on the planet, you have to look at the revenue composition. 5 years ago, if you bought NVIDIA, you were betting on the PC gaming cycle, ray tracing, higher frame rates, the seasonal holiday lift. Today, gaming is a rounding error, pulling in barely 9% of revenue, while the data center segment consumes a staggering 88%. This isn't just a pivot, it's a fundamental change in the business model. NVIDIA now sells an entire full-stack ecosystem: the CUDA software platform, the networking, the interconnects, the GPUs. By creating this proprietary software lock-in, they've transformed from a volatile hardware vendor into a high-margin utility provider. The legacy framing of NVIDIA as a cyclical semiconductor company is the biggest mistake you can make. It ignores the fact that their gross margins are sitting near 75%. They aren't just selling chips, they are selling the only infrastructure that can train the models powering the global economy's transition to agentic AI. Looking ahead, the catalysts are as much about the physical world as they are about the digital one. The move into robotics, autonomous systems, and physical AI isn't just marketing fluff, it's the next phase of the roadmap. The company is actively building the simulation engines and specialized hardware to bridge the gap between digital LLMs and the physical world. However, you cannot ignore the risks. Geopolitical friction, specifically around chip export restrictions and the fragile nature of a supply chain that relies on limited players like SK Hynix and Micron, is a real, persistent threat. If we see a breakdown in the semiconductor supply chain, or if the CapEx arms race among the mega-cap hyperscalers finally cools off, the growth rate will naturally revert to the mean. But looking past the short-term price noise is the only way to play this. The world is transitioning to an AI-native infrastructure, and NVIDIA is the only gatekeeper that controls the flow of that transformation. Don't let the headlines about peak AI distract you from the fact that we are currently in the most significant infrastructure build-out since the internet. The short-term price action is for the traders. The long-term value is for those who understand the physics of the future. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thanks for watching. Don't forget to like, comment, and share this video to support the channel.